Hey everybody, just want to thank you for being here. I know Michael Saylor is a couple rooms down, so you guys are the committed people who want to learn about mining. So want to welcome Max and Charles here with us, and we're going to talk about Bitcoin mining, whether that it's good to invest in Bitcoin directly, to invest in miners. And I'm Brian Estes, I'm the CEO and CIO of Off the Chain Capital. We're a private investment fund in the space. We're registered with the SEC, so I have to give a little disclaimer. Anything I say is not constitute investment advice, so I just have to get that out there to be good with our compliance department. But I'd like to introduce, like I said, Max and Charles. You want to go ahead and give a little brief background on what you guys do?
Yep, sure. Mic's not working here, but yeah, Max Shapiro, co-founder, managing partner at Cadenza Ventures. We're an early stage venture capital firm based in New York and San Francisco. We were actually born out of the corporate venture arm of BitMax. So we started BitMax Ventures back in 2018 and formally spun out in 2021. And our most recent fund that we're investing out of now is anchored by Vanek Associates.
My name is Charles Hwang. I'm the CIO and founder of Lightning Capital. We have 3 different trading funds, and then we also have a Lightning Energy business that is Bitcoin mining. And I have the same, we're also SEC registered, so same disclaimer that none of this constitutes investment advice.
Okay, Max, let's go and start with you. So I got into Bitcoin in 2014, and I was questioning, I come from traditional finance, so I was looking at, do I invest in mining companies? Do I build a mine myself? Do I invest in Bitcoin? Do I invest in Bitcoin companies? Can you just talk about some of the pros and cons of versus buying Bitcoin versus investing in Bitcoin miners?
Yeah, definitely. It's a very interesting topic and debate whether you should purchase Bitcoin directly or invest in mining companies or operate a mining company to have long exposure to Bitcoin. Some of the benefits of investing in mining companies versus going long Bitcoin would probably be depreciation if you're in a jurisdiction that has high tax rates because there's a large capital expenditure outlay when you buy the hardware, and this hardware typically depreciates over a 3 to 5 year life, which is kind of a faster schedule. So you can use that depreciation to offset income in other areas. Some of the cons, though, and maybe not cons, but differences would be you have exposure when you're mining Bitcoin to the cost of electricity that can be volatile, as we saw over the last few years on the upside, which was net bad for the average miner, assuming they didn't have some sort of unique electricity infrastructure or arrangement. And the other thing that you're exposed to is hash rate. And there are properties of Bitcoin hash rate that are correlated to the price of Bitcoin, but there's also properties of it that deviate from the price of Bitcoin. And you can hedge both electricity and hash rate, but there would be a cost to hedge those two variables, which would also be a negative versus just buying Bitcoin directly. So that's my view, and my personal take is that if you want long exposure on Bitcoin, then just buy it directly. That being said, I know there's others out there that would argue differently, and I think Charles has an opinion on it. So,
yeah, so Charles, Bitcoin mining generates cash, right?
Yeah, that's right.
You get Bitcoin, you pay taxes on it, but in the end you get dollars, right? Whereas when you buy Bitcoin, what are you buying? Like just a token? It doesn't produce cash. Can you just talk about the difference between a fixed asset like Bitcoin versus a cash generator?
Yeah, for sure. Just my background is also traditional finance, hence the suit. And I've been in traditional finance since 2000, trading equities. And when I look at Bitcoin, I got into Bitcoin in 2013, and I looked into mining because I'm looking at data. I'm trying to understand the data behind the mining side. And when I look at this, ever since 2013, at first I was like, I'd rather buy Bitcoin than go into mining. Because if you remember, the whole ASIC production and how we evolved in ASIC machines, at first it wasn't even ASICs. You could mine through your CPUs, and then you it went from CPUs to GPUs and then ASICs. And the ASIC competition was very fierce at the time, and it still is to some extent, that timing was such a big key to all this. And what I mean by that is, what I noticed throughout the cycles is most people started mining at the peak of the market. And they're buying the machines, and then you have this long lead time to get the machines, because everyone's trying to buy these machines. And then the cycle goes down as we see it flatten out, like today is a great time to be buying machines because all the machines are priced in Bitcoin. And so you're getting cheap machines. And then the second piece of it is finding cheap electricity. And the way I see it is energy arbitrage. So if you're finding cheap electricity, you can mine Bitcoin as low as like $5,000 per Bitcoin. And so that generates some amazing margins for your business, amazing cash flow, and that's where I see the return. So like one of our ideas is if you have Bitcoin that you have just sitting there not generating cash flow, you could use that without a taxable transaction, invested into a mining business, and now you're generating cash flow off of that. The key is just having the right team to do that because there's so many moving parts for all of this. It is not a simple thing as plug and play. We joke about this in the mining industry. People think you buy an ASIC machine, you plug it in, connect it to the pool, and you should be generating Bitcoin. It is not that simple, which is why I think a lot of VCs have not been investing in this space.
So you mentioned electricity costs. So can you give us a range of like what's a good rate versus not a high rate? Like what's that range there?
Yeah, so I would say if you're around over 7 cents per kilowatt hour, you're really struggling because what's going to happen in 2024 is the Bitcoin halving event, and when that occurs and the block reward drops significantly, that's a big risk, and no one's planning for that out. I shouldn't say no one. I mean, I think all the mining companies recognize that, but what needs to happen, I think, you got to get down to like at least at most 3 cents per kilowatt, and that's what we look out for. If we can find that those numbers work really well because there's a certain margin of risk that we're comfortable there, that during the halving event, we have enough that we could still be very profitable mining Bitcoin. Mm-hmm. And we're also dependent on Bitcoin price. So if Bitcoin does drop, we still have a high margin on that.
Mm-hmm. What about just dig a little bit deeper? What about like the utility companies out there? It seems like they would have a strategic advantage over a retail client or even an institutional client wholesaling. For example, one of our clients we did consulting for, they were being paid to take electricity off of the grid.
Yeah.
And so they were being paid by the windmills to take their excess electricity. They were paid 7 cents a kilowatt hour. And then they were turning around and mining Bitcoin with that, making 25 cents a kilowatt hour. So they had an unlimited profit margin.
Right.
And so, how do you compete with a negative electrical cost like that?
Yeah, for sure.
If the utility companies get into this business.
I think that's where we're seeing it going. I think what we're seeing in terms of the rumors that I'm hearing is anyone who has access to cheap energy is starting to look into Bitcoin mining if they haven't already started mining. Mm-hmm. And so you see one of the booths out there is Shell Oil. Yeah. I'm sure they're looking at Bitcoin mining if they haven't done it already. Mm-hmm. Rumor is that what we hear is that the Middle Eastern countries have been mining Bitcoin already and putting it in their treasury. So they're recognizing this is an energy arbitrage situation where they can take their cheap energy and turn it into Bitcoin, which is real money. Mm-hmm. It's a real hard asset.
Yeah. Max, you talked about the tax complications with mining Bitcoin versus just holding Bitcoin long. Do you want to go through some of the, when you mine Bitcoin, how is that taxed? What is that?
Yeah, definitely. If you buy Bitcoin directly, that doesn't create a taxable event, at least in the U.S. Only when you sell that Bitcoin, if there's a gain or a loss, it would create a taxable event. But when you mine Bitcoin, you spend money to purchase the hardware, and then you depreciate the cost of that hardware over a 3 to 5 year life. You use that depreciation to offset income either from that operation or income from other areas, which reduces your tax liability. But also the process of receiving Bitcoin from your mining operation is considered revenue. So all of that would be taxed as well as it comes in and as you liquidate it for US dollars, assuming you liquidate it and draw down the Bitcoin reserves that you've earned. So that's typically how to think about it from a tax perspective. So in a jurisdiction where there's high tax rates, the argument could be made that going long Bitcoin and not creating taxable events is tax efficient. But then the argument could also be made that mining Bitcoin and leveraging the depreciation to offset income from other areas could be tax efficient as well. So if you have income from other areas, then maybe there's an argument for mining Bitcoin to use to effectively offset that other income.
Okay. And so Bitcoin mining it's income tax, or it's what is that?
Yeah, it's a good question, and for what it's worth, jurisdictions around the world treat it all, very differently. But yeah, any Bitcoin that comes in is considered revenue for an operating business. So yeah, that would be considered income tax. But again, not a tax lawyer here, so consult with your tax advisor in your respective jurisdiction. But.
Okay, so Charles, there are different risks with each one of these, right? Buying Bitcoin long, holding it forever, that's a risk. Mining Bitcoin has risk, right? We've seen a lot of mining companies go bankrupt over the past year or so. You want to talk about the different risk characteristics?
Yeah, I think speaking of publicly mining companies or just even the private ones, I think what happened is what we see is low interest rate created cheap money. And as we got cheap money, that created all these mining companies to over leverage. One of the biggest problems with a lot of the mining companies is there's no treasury management. It's a HODL strategy. A HODL strategy doesn't work in this environment because then we see the public miners take their Bitcoin holdings and are forced to sell it at the lowest prices. And as an operator, you have to manage that treasury. And that's where I see the biggest mistake in a lot of these mining companies is that they have to take some sales to pay for the operations. You have to do that. If you're operating at a low cost and you're getting these high margins, you need to manage your cash reserves so you're not forced to sell Bitcoin at the low. And it exasperates the problem in our sector because the belief that I have is that miners are really the net sellers of this entire industry. And when the market goes down and they're forced to sell, it just pushes the market so much lower than it should have gone. And leverage is the danger behind this. I mean, this goes back to what's wrong with our dollar, right? The dollar is causing all this problem. And if we didn't have all this cheap money out there, we wouldn't be in this situation.
Mm-hmm. So in about a year, I think May of next year, the supply of Bitcoin gets cut in half. The reward of Bitcoin gets cut in half. So right now there's 900 Bitcoin a day being rewarded out to the miners. That's going to get cut to 450 Bitcoin a day in about a year. So when that reward gets cut in half, how do you think that affects the profitability of miners and the competitiveness of the industry?
Yeah, definitely. So there's a few things to think about. So when you mine Bitcoin, the reward that you receive is broken down into two pieces. One is what's called the block subsidy, and the other piece is the transaction fee reward. So the block subsidy has been the lion's share of what miners receive. Recently, given the network congestion, transaction fees as a percentage of the total reward have actually ticked up, which is net healthy for the Bitcoin network. But the block subsidy at halvings gets cut in half. So right now it's at 6.25 Bitcoin per block that's mined that gets distributed to all of the miners based on whoever validates the transaction on the network. And at the point of halving, which is currently set for April 27, 2024, and it changes based on a couple of factors, we'll go to 3.125. So if you keep all variables consistent around mining Bitcoin, such as the price of Bitcoin, your cost of electricity, even if you have a good rate of electricity, let's say 3 or 4 cents per kilowatt hour, and you keep the hash rate the same, and transaction fees the same, then the block subsidy going from 6.25 to 3.125 would make it, much significantly less profitable to mine Bitcoin, and I would actually argue probably unprofitable or break even. So today, based on a cost of around 6 kilowatts per hour, not including any operating expenses and the current price of Bitcoin and the current hash rate, I would say that miners can mine Bitcoin at around 15,000 plus or minus 2,000, depending on electricity and the machinery that you're using and the hash rate of the day. Once the block subsidy goes from 6.25 to 3.125, keeping all other variables the same, the break-even price would be around 30,000. So it would be unprofitable. We're going to see a massive impact. And typically what happens at halvings, and I'm looking at the hash rate chart right now in front of us here, but you'll see a bunch of miners turn off their machines or stop validating on the network because it's unprofitable. And it's an interesting dynamic because you see the hash rate decline as miners leave the network. And some have argued, that short period in time is actually, a security risk for the network because you have, more concentration of miners. But yeah, that's typically what happens at halving.
And Charles, go ahead.
So I want to add an interesting scenario that I've seen in every cycle is that in every cycle leading up to the halving event, we see the price of Bitcoin go up. And what do people do when they see the price of Bitcoin go up? They start buying mining machines. And as they're starting putting orders for mining machines, that supply chain gets clogged up. And as we see it get clogged up, people think, well, I'm mining Bitcoin at 30,000 a cost. It doesn't matter because Bitcoin, hypothetically, let's say it's at 100 grand. And so they look at that margin and they say, wow, this is highly profitable. Well, let me buy more machines. And more orders go into the system. Supply chain gets even more backed up. Your lead time goes from a month to 3 months to 6 months, a year out. And now you're waiting for the machines. You already paid them because you paid them in Bitcoin. And so your Bitcoin's gone. And they hold on to it while you're waiting for these machines. And then once that halving event happens, they start seeing, oh, wait, this is not as profitable. Where are my machines? I need my machines now. And then suddenly we see the price drop again. And so we go through these cycles every time. And I bet you we're going to see the same thing again in this cycle. And that's why we're going to see the hash rate go up. We're going to see the hash rate continue to go up. And so I think it's going to repeat itself all over again. And that's where I see this happening. Because as we see price goes up, people get bullish again. And that's why I tell everyone this is the best time to be investing in this. It's not a year later. A year later is too late. You're going to miss out on this. Because remember, when the price of Bitcoin goes up, your cost of machines go up too. And so there's a direct correlation when we look at that.
Yeah, Max, you mentioned that miners earn rewards for participating in the block rewards, but they also earn transaction fees. And I think it was a couple weeks ago, the transaction fees were actually more than the block reward. And that's the first time I've ever seen that. And you want to talk about what that means like today and like going forward?
Yeah, definitely. It's a very interesting topic, and I think we were all set to be on this panel before this market event took place. So the timing is interesting. Yeah, so as I was saying, the reward that miners receive is broken down into two pieces. The block subsidy, which gets halved at every halving and will eventually go down to next to nothing. So at some point, from an existential perspective, the block subsidy piece of it is going to go away for the most part. So the only thing that miners are going to be receiving in the future is the transaction fee reward. And it's interesting because the transaction fee reward as a percent of the total earnings that miners get has been relatively low. But what we just saw as a result of increased network activity, largely surrounding ordinals and BRC20 tokens, was the transaction fees be relatively high. And there's been a lot of debate as to whether Bitcoin can be around forever because of the halving dynamic. If miners don't have an incentive to validate transactions on the network, once it gets halved down to nothing, then we don't have a network in the future. But if the transaction fee reward is relevant, then miners do have an incentive So it's interesting to see it play out now, and hopefully the activity on the Bitcoin network will continue to increase so that there is that incentive for miners to continue to validate transactions on the network.
Charles, you want to add?
Yeah, I want to add that if you know the details, it has to do with ordinals that are on the Bitcoin blockchain and create this whole, we'll show you later, the mempool got very backed up, and in order for you to go in front of the mempool, you have to add more costs for your transactions to hop in the front of the line. And I think I saw as high as like 8 to 9 Bitcoin in a block that were, people are paying for transactions. And I think it's such a bullish sign for that, to show that people are willing to pay that amount to make sure that their transactions are confirmed on the network. Because historically, people are saying, oh, transaction fees can never be that high. And everyone's thinking Bitcoin is like a credit card, compared to a credit card company. And it is not a credit card company. It's like a wire service. It's final settlement. It's one of the best networks out there for that. And it is showing that people value it so much that they're willing to pay those transaction fees. So it's encouraging for me to see, as we go forward through the cycles, that in the future, the miners are not going to be dependent on just the block reward. That block reward plus the transaction fees is going to be a very lucrative part. And this is what I was talking about, that there's a lot of moving parts when it comes to mining that people aren't calculating for. Because the biggest problem with running the models, none of the data is static. The hash rate is constantly adjusting. The mempool is different in different periods of time. And Bitcoin price is moving. Bitcoin price is never static, as you all know. And so it's a matter of accounting for all of those moving parts to make sure that you're mining Bitcoin at the lowest cost.
So you mentioned Visa and like Bitcoin's, people call Bitcoin like a cryptocurrency.
Yeah.
But it's kind of misnamed, right? It's really digital property. And so it's not like you sell your house, and you're not trading your house daily, right? You shouldn't trade your Bitcoin. When you look at the average Visa and MasterCard transaction, in 2022, it was around $50 per transaction.
Yeah.
The average for Bitcoin was over $50,000. And that's up from $5,000 when I first got involved with this. And you could just see that in the future, it'll probably be the average will be 5 million or 50 million. It's going to be, like you said, the final settlement layer. So we're not going to use it for daily transactions.
That's right. And I think that's where the media does a disservice to our industry, where they're always comparing it to credit card companies. It is not a credit card company. It is final settlement. It's open 24/7. I can send it to anyone in the world at any time of the day. I've done presentations on Bitcoin on a Saturday, and I had someone show me their QR code for the Bitcoin wallet, and I told them, I'll send you Bitcoin right now if you put it on, show it to me, and we send it on a Saturday, where if I wanted to wire someone money on a Saturday, good luck with that. Let's wait till Monday. And this is where the Bitcoin network is so resilient and is such a powerful network.
Okay. Before we get to the slides, let's just touch on risk and regulations.
Yeah.
So Senator Lemus was talking earlier about there's a proposed 30% mining tax. She said that will never happen, but it seems like people are going at the government's going after the mining industry. You guys want to talk about that a little bit? Max?
Yeah, sure. Look, I'm not too familiar with the regulatory environment as it pertains to Bitcoin mining, but there's been a lot of debate globally, both in the U.S. and outside of the U.S. Some governments have tried to get rid of it or ban it entirely, as the view has been, it could be bad for the environment, or it's drawing, from power grids and driving the price of electricity up. And then other governments have tried to use it as a tool to bring in innovation and capital. I saw the 30% tax proposal. I think that's a little ridiculous, but At the same time, right, we're experiencing this dynamic right now in the U.S. where both sides are debating over fiscal spending and where they can earn more money to get themselves out of a deficit, which I think is going to be very difficult. So it's unsurprising that they're looking at things like Bitcoin and other areas just to get as much revenue as they can. But yeah, I agree. I think that'd be ridiculous, and hopefully that doesn't go through. So.
Charles, you want to touch on that?
Yeah, so I would say that one of our beliefs, at least rumors in the industry, is that the hash rate has been going up so high because there have been some sovereign nations mining Bitcoin. And if we as a nation, the United States, does not get ahead of this and starts to shut this down as, in choke point 2.0, we're in trouble as a country. And I think our federal government, hopefully we have, the team at Lightning Capital meets regularly with congressional members who are very bullish on crypto. And they're helping to fight it, help fight these taxes on Bitcoin mining. And I really also, I grew up in New York City and now moved down to Florida 2 years ago because I believe in state rights. And I think that's going to become very powerful over time. That what I believe is the states are going to be having more power to regulate this environment. And we're seeing that migration already into Florida, into Texas. And so I think that may continue if a state like New York, who's very bearish on Bitcoin mining, they're going to push all that talent out.
Mm-hmm. So let's go ahead and queue up the slides. So you talked about the hash rate. Right
Yeah,
there.
so we see the hash rate. And if you look at the moments that the hash rate drops, it's not when the Bitcoin halving event happens, but typically about a year later. And we usually see that at every cycle, which is why I believe the hash rate is going to continue to go up. And we'll see it, probably May of 2025, that the hash rate is going to drop. And because we're going to see people start to flow into it. And we have some data to back up that we believe, and this is not investment advice, that Bitcoin price will go up leading up to this.
So let's just point one thing out too. Between midpoint 2021, there was a huge drop-off in the hash rate. That's when China basically told the Chinese miners to unplug your machines and move them out of the country.
That's right.
So the network was down for a while, or it dropped 50% of the hash rate for a while. But then what happened right after that? You want to talk about that?
Yeah, so we see suddenly that the Chinese miners start to move into countries like the United States because we have, and I would make a strong argument that we have strong private property rights because they're afraid that a country like China can seize all of the machines and take it over. And so we see the hash rate, the lead time on that was moving the machines out of the country into other countries like the US. And so that's why we saw a subsequent jump in the hash rate.
Yeah, but just look how far it came right after that, right?
Yeah.
So,
and we're seeing it hit new highs every day.
So Max, you mentioned this earlier. You want to talk about the mempool?
Yeah, so maybe you want to...
Yeah. So the mempool, if anyone knows what the mempool is, it's basically your transactions waiting in line to get confirmed into the next block. This was taken a couple days ago. I'm not sure where we're at today. But you'll see there's 230,000 transactions in the mempool. I think I saw it as high as 500,000 transactions waiting into the mempool. And so if you attached a very low value to your Bitcoin transaction, you're going to see it take a long time for it to confirm. But if you wanted to pay a lot of money, I think if you paid like $50, you could jump ahead of the line. And that's where we see the transaction fees that were paid being more than the block reward being very powerful. And I think what we'll see is as we get more adoption, the problem is it's still nascent technology. As we get more adoption into Bitcoin, you're going to see those transaction fees increase. And if sovereign nations are very involved, like you said, those average transactions, probably in the millions at some point.
And then the last chart we want to go over, either one of you guys want to talk about?
Yeah, you can take that.
Yeah, sure, I'll take this one. So yeah, what you're looking at here, the red line is the price of ASIC miners, so the hardware that's used to mine Bitcoin, and then it's overlaid, the yellow line or white line is the price of Bitcoin. So you can see that it is very correlated. I think the correlation broke down in 2023 as a result of a lot of the bankruptcies that took place in the industry. Charles was talking about leverage. So a lot of these miners took leverage and were unable to or started defaulting on some of their loans. We saw Core Scientific, Compute North, and as a result, their lenders wanted to take over the collateral, which in some cases were the mining hardware. So a lot of that hardware has come into the market, and that's why you're seeing kind of an oversupply and the price drop, which is very interesting because it could be an opportunity to purchase in anticipation of some of the things that we've discussed here today. So.
Max and Charles, thank you for taking your time today to share your thoughts and your insight on all this. We really appreciate it.
Thanks for having me.
Yeah, thanks. Yeah.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.